Today I'm going to cover the stock market predictions, estimations for 2025 from three different points of view. Mike Wilson, Stephanie Link, and Cathie Wood. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is February 18th, 2025. Last week, I was off last week, you may know that. So I was not doing well. I was not feeling well. I had the flu. So if you've had this current version of the flu or know someone who has, I don't have to say anymore. It is terrible. It really knocked me out. So I literally was not able to do the broadcast. So I'm glad I'm able to do it now. I'm back. I'm well. A lot of people experience this as it goes on for a couple of weeks. Fortunately, I had 2 or 3 days, maybe 3, but 2 to 3 days of really bad symptoms, and then I recovered. So I'm thankful for that. It was kind of like COVID. I mean, I thought I had COVID because the symptoms were kind of similar. They were really bad though, and so when someone says they have the flu, give them a lot of sympathy. And also, now I'm here in Montana, and if you're in Montana, you know what I'm talking about. We have a lot of snow. It has been cold and a lot of snow. So I'm going to have Chris take a couple of pictures, so you can just see from my front porch what things look like. And I normally wouldn't do that. I just do it because the amount of snow is so unusually high. Okay, as I said, I'm going to cover the 2025 market expectations from the perspective of Mike Wilson, Chief Investment Officer at Morgan Stanley, and Stephanie Link, Chief Strategist at Hightower, and Cathie Wood, the CEO of ARK Invest. 3 very different perspectives, and I know that all of them have had periods where they have predicted the market correctly, and where they have not predicted it correctly, and I'm aware of that. But they all are credible. I happen to like all of them. I think they have a good perspective. When they're wrong, they admit they're wrong. But my point is, it'll give us 3 different perspectives. So to begin with, I'm going to take a look at Mike Wilson. He's being interviewed by Joe Kernan and Andrew Sorkin, and he's looking out for the next 3 to 6 months. He expects continued growth, but in different sectors. We've had certain sectors that have been hit, that have been kind of in recession, and some others have not been. He sees a shift in that, and then he even comments that maybe the government is now going into recession. And that's a different concept. So, but anyway, he explains this, so take a listen to Mike Wilson, Joe Kernan, and Andrew Sorkin.
Our next guest saying that markets will be choppy for the next 3 to 6 months, and he views a broadening in the earnings recovery as critical to his year-end S&P price target of 6,500. We are happy to welcome back Mike Wilson to Squawk Box. He is Chief Investment Officer, Chief U.S. Equity Strategist for Morgan Stanley. It is great to see you after quite some time. Nice to see you, sir.
Yeah, good morning.
So you think the next couple months are choppy. Does that mean don't do anything and wait for some kind of dip based on this sort of longer-term arc you've got going?
Not at all. I mean, look, we made that call back in November, December, just saying, look, we priced a lot. 6,100 was kind of our short-term target. And look, there's a lot of news coming out, and we think the growth, so the policies initially are sort of growth negative, which is, immigration sort of enforcement, and of course the tariffs, and that's just a lot of noise. So we're just digesting that. Plenty to do underneath the surface. I mean, financials have been phenomenal. We've seen it broadening out to some degree. In fact, software over semiconductors has been a great trade for us because as
software over semiconductors,
right? Because of the fusion of tech now and the application layers being built out, and we think that got confirmed a bit with the DeepSeek, announcement. So,
do you think that the semiconductor game is taking a pause, or it's over, or what?
Well, it has taken a pause. I mean,
I know it's taking a pause, but is it forever a pause?
Of course not. I mean, it's a cyclical group. And look, away from the AI beneficiaries CapEx has been pretty weak for most other semiconductor type spending.
Right.
And of course, now with this DeepSeek potentially leading to the next excitement part of AI, which is the diffusion of it in the application layer. That's the opportunity, is going back into the software stack.
Like, there was a time where you were worried about, I think, earnings, which could forecast like a slowdown in the economy that could have been the R word, could have been a recession. Yeah. That never happened.
That's right.
Have we learned to manage the economic cycle where it doesn't have to? Are we closer to it happening now because it didn't happen, or does it not have to happen unless there's a mistake?
Well, I think a couple things happened last year. What we missed is, we didn't miss it, but we actually called for it, which is a rolling recession. We've had recessions in many, many industries. If you think about the last 2 years, we've been in a recession in housing, in autos, in manufacturing, in consumer goods. A good part of the economy has been. So
we're not closer to that inevitable day of reckoning for something happening.
No, I will say this. I think what could be interesting this year is you could have a recession in government, right? If you have a recession in government, that may actually cause unemployment to go up to a level.
That could cause a recession.
That's right.
Yeah.
But it may not be that bad, Joe, for the rest of the economy, because they've already been in sort of this soft recession. So that's actually our bull case, is that the government shrinks. The crowding out stops. It allows the Fed to cut rates at some point, and the broadening out can actually happen. A lot to happen between here and there, but that is actually the bull case.
Okay, next is Stephanie Link from Hightower. She, again, as Mike Wilson, she's, in my opinion, is very credible, and she sees a positive outlook for 2025. Maybe not as robust as 2024, but a positive outlook. So take a listen to Stephanie Link.
So let's get into it, Steph, because here we are, a month into the year. The market is effectively at all-time highs. Let's go from the top down, sort of outlook for this year, the economy, the markets, those types of things.
Yeah, well, I think that this year is going to be a little bit harder. I don't think we're going to see another 20% plus S&P 500 return. I don't think we're going to see 3.4% GDP growth like we saw for the last 2 years as well. And it's really pretty simple, guys. We're not going to have nearly the amount of fiscal stimulus put in place in 2025 like we have seen over the last 5 years. We had to put stimulus in place, both fiscal and monetary, during COVID. I get that. It worked. We recovered after we closed down and the world closed down. But we overextended, in my opinion, on the fiscal side. That's why we had so much inflation. All that being said, it led to better growth. So we're getting inflation to come down. It's still sticky. We can talk about that as well. But the stimulus from the fiscal side is certainly not going to be the case. Now, offsetting that, you're going to have pro-growth initiatives from Trump. You're going to have deregulation, lower taxes, et cetera. So I think you add it all up, and maybe we see a decel in the GDP to like 2% or so. By the way, that's still above trend. Trend is 1.5%. And if you have 2% growth, I think inflation will kind of be around 2.5% at the end of the day. And the Fed, I don't know what they're going to do. They cut, they not cut, doesn't matter to me. What I prefer to look at is, the growth in the economy. If you're growing 2%, and you have inflation coming down, and you have a solid consumer driven by labor and wages, you have manufacturing renaissance happening, that's all good for earnings. I think you could do earnings about 10%, 12%. And we all know our good friend Larry Kudlow. He has told us right from the beginning of time, stocks follow profits on the way up and on the way down. And right now they're going up, but they're not going up as much as they had. So I think maybe you're looking at like 7 to 10% returns this year, which is not so bad because the long-term average is 7.5.
And finally, I want to play a piece from Cathie Wood. Cathie Wood is the CEO of ARK Invest, and she gets criticized some. The predictions that she's made have sometimes been wrong, and when they've been wrong, sometimes they've been badly wrong. She started ARK Invest kind of at the top of the technology or innovation market, and it just kind of crashed right after she started her company or the funds that she's in. But she has a long-term view, and if you are in the space of innovation or kind of bleeding-edge technology, she's kind of the name that comes to the top. But when you're in innovation or the outer edge of technology, whatever's the latest thing going on or going to be going on in the next coming years, it's a rough ride. I mean, it is not smooth. It may be a good rate of return over a long period, but in the short run, it's a very rough ride. So she does get criticized. I'm aware of that. I personally think she's credible, but I, make allowances for the fact that she is in the innovation space, and that's you could call it early stage companies, and that's just a very rough ride. Even though she and her team probably do a very good job, put a lot of effort into trying to select their investments carefully, it goes up and down quite a bit. But the comments that she makes, the one is in AI. She begins with AI. She says, it's all AI all the time in everything. So it's in technology or innovation, it's all about AI. And I'll comment on that later. And then she gets into biotech, and the speed of innovation in biotech is going up at a factor of probably 10. And that partly is due to AI as well. And then thirdly, the self-driving cars. Again, same thing, AI influences that. And she points out a couple of companies that have made it so far that may survive. But it's it's a technology that is maybe a little ahead of its time, but you could say over time you can see the possibility that that could be successful. So anyway, take a listen. I think you'll enjoy the perspective of Cathie Wood as she goes through these three different aspects, three different sectors of the early stage companies.
Hello, everyone. My name is Cathie Wood. I am CEO and CIO of ARK Invest, and I would like to share with you our Big Ideas 2025, at least my takeaways from them. Our analysts have done an amazing job. I think this is our best one yet. So I'd highly recommend that you download it from ark-invest.com and take a look at all 140 pages. Our analysts themselves, will be sharing their takeaways in the next week or so. So I thought I'd summarize some of the highlights first. AI all the time. AI has been the big story for the past 2 years, and it's still the big story. In fact, it is the biggest catalyst to all of the innovation taking place out there. It is the reason that the world seems to be speeding up. And I'll just give you a few examples of how quickly things are happening. So on the autonomous front, we have autonomous coders in the software development space. And in late 23, this autonomous coder, and you'll see it in Big Ideas, was able to do 3% of a project that a developer gave the AI system. By the end of last year, that was up to roughly 75%. And soon we think it will be very close to 100%. So basically, a developer or an engineer telling a coder, this is what I want to do, and the AI basically writes the code for the engineer, increasing the engineer's productivity manyfold per year. Another example is in the multi-omic space, so drug development. In the area of research, researchers often test hypotheses for new drug targets, and we've scored how long it takes them. At the end of 23, or in the year 23, they were able to test 20 hypotheses in 1 year. By the end of 24, 200 hypotheses, 10 times more productive. So that tells us that the cost of research and discovery as we're moving towards curing disease is collapsing. So we're going to get a lot more of that kind of research and development. And then a third really good example of autonomous is full self-driving. Now, 10 years ago, or maybe 11 years ago, when we were writing about autonomous and when we thought it would roll out, there were about 10 companies, mostly auto companies, who said they were going to be there within the next 5 to 6 years. And we thought they were, but the only one who made it, at least from a commercialization point of view, was Waymo in 2018. Well, here we are in 2025, and Waymo is still geofenced by territory. We believe this year Tesla will deliver a fully autonomous service. They're saying in June in Austin, we'll see the debut, and we think that it will roll out across the country pretty quickly thereafter.
And I wanted to comment on this. Following Cathie Wood, it reminded me of what we have been doing with AI. I don't talk about this often. I do with my clients, but I don't talk about it publicly. I'll talk about it a little bit here and then maybe more later. About, well, maybe a year ago or so, maybe a little longer than a year ago, Zach Simonov, who is my son-in-law, an AI engineer, coder and engineer, and he began to look at what we were doing while he was at Fidelity, and in his spare time took a look at what we were doing to see if he could add a component of with AI to our methodology, which was mathematical, but it was not AI. And then after maybe 8 months or so, he came out with a version which looked exceptionally good to us, and we decided to test it for a while, putting our own money, my money and his and Spencer's money behind it, and to just see how it worked. Well, it did really, really well. And we were very pleased, and then after a few months, we opened it up to clients. If they were interested, we didn't really promote it, but if they were interested, then we followed up on that. And in the 6 months or so since we came out with it, it has produced a 65% annualized rate of return. So it's only been out about 6 months, so the rate of return, the actual is about half that. But on an annualized basis, about 65%, and which is about 3 times the rate of the S&P 500, and the risk, the beta, is 0.47, which is more than it's not even half the risk of the S&P 500. So you get 3 times the rate of return at half the risk, basically. And so but it has been somewhat of a rough ride. I've not been pleased with that. So this is all version 1.0. So he is now, he quit Fidelity and now he works 100% with us. And so he is now working on version 2.0, and we're expecting that in the coming weeks. And then my hope is that we're going to have, based on all the ideas we've got on the table with AI, that we're going to have probably 10 versions this year. I'd love to be at V10. I would love that. But it's just bringing AI into the investing space. So there is just a lot of opportunity. I don't hear about it very much with investments. I think a lot of AI is being applied to high-frequency trading. Certainly, investment managers who are in a different segment of the market than we're in, because the segment that we're in, I do not hear about it very much, but it is certainly something that's kind of begging for an opportunity to be used to help people harvest better gains with less risk. So that is my report for today. and hopefully this was helpful, these three different perspectives. And I'm glad I'm back. And if you have questions or comments, leave them in the comment section below.